we know the game. It's a long-term game. I was looking at the charts of Bitcoin, and it either kind of bases around these levels, or that wedge that you're looking at breaks lower, and before you know it, we go back to the 250-week exponential moving average, which is 22,500. I don't know.
Wow.
If this is 2018 again, that's pretty much what it would do. It'd have another sharp spike lower to hit that 250-week moving average. I don't really know. I've thought that it should be basing. What's really interesting, you've thrown 8% inflation, you've thrown war, you've thrown 6.5 or 7 rate hikes priced in, you've thrown everything at it, and the market's not made new lows. That's a positive, but maybe that's just a false hope. Who the hell knows?
The cryptocurrency market is in a lot of pain right now. Bitcoin's price quickly rose above and then fell back below $40,000 after President Joe Biden signed a sweeping executive order on cryptocurrency last week. Bitcoin jumped in price by 10% to above $42,000 following news of the executive order, which calls for government agencies to create a plan to regulate cryptocurrency and to consider a government-issued central bank digital currency. This is marked as the first concrete step by the White House to regulate cryptocurrency, which has emerged as a key element in the war in Ukraine that continues to drive extra volatility in the crypto and stock markets. But the surge was short-lived, with Bitcoin later dropping back below $40,000, where it was before the executive order was announced. Due to this sudden rise and fall, many investors are wary of the next move of Bitcoin and where it is headed in 2022. Hello and welcome to Money Talks. In today's video, global macro investor and Real Vision CEO Raoul Pal updates about the crypto market volatility, the influence of war, Bitcoin as a store of value, and institutional demand for Bitcoin. Raoul Pal also talks about supply-driven inflation and upcoming Bitcoin ETF with an exclusive insight into his crypto portfolio. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Let's dive right into the video.
Because one of my hypotheses is retail investors, everyone's got negative real wage growth. So everyone's getting squeezed right now. So I wonder if the audience is getting squeezed on their income and they've got less money to invest in crypto or not.
Raoul Pal shares that Bitcoin has two important qualities. One is the store of value and the other is the growth quality.
Well, the problem is Bitcoin, unlike gold, has two qualities. One is the store of value quality and the other is the growth quality. What can the network be used for, the new technology, and those things are always interplaying. So this is why you see this kind of schizophrenic nature of Bitcoin and crypto overall is it shifts narrative. So it's not correlated all the time. So we have passing correlations as opposed to total correlations. So over a longer time period, I wrote a tweet about this, over a longer time period, there is very little correlation over anything. Over short-term correlations, over short-term time periods, you've got correlations with all sorts of things.
Raoul also talks about the key factors driving the institutional demand of Bitcoin.
I spent a long time looking at what is the predominant driver of price of crypto, and I came up with the fact that it's the amount of volume kind of multiplied by the number of wallets. And that is a good fit for pretty much everything, number of active wallets. So we need, for the price to increase, we either need daily volumes to increase or the number of active addresses to increase. Right now, we've got neither. So we got to think, okay, how will we drive that? We either do it from further retail participation, but in an inflationary environment where real wages are negative, it's difficult. So therefore, it would have to be institutional. Now, as I've said to you on the show before, I spent all day speaking to institutions, and pretty much everybody is they went last year to get approvals. They've now started getting approvals. They're now trying to figure out how the hell to do it. And so don't forget, 32 billion last year went into VC because they couldn't put it on their balance sheets, and it's easy to do VC. So that tells you there's pent-up demand from institutions, but the reality is they just don't want to own Bitcoin on their balance sheet. One of the things I've done on the side is built a fund of funds business that invests in crypto hedge funds, because you need institutional product right now. There's no institutional product. They're not going to use the ETFs because they're all futures based. Well, one of the things that I think people haven't talked about is this rise in prices is a massive tightening of monetary conditions. From my expectation, I think we've already hit 200 basis points, and that's why the yield curve is essentially zero. So the ability of the Federal Reserve to raise rates without a recession is pretty close to zero. So therefore, if a recession or something close to it is already being priced in by the yield curve, then demand should come down anyway. So I'm actually less of an inflationist over time. I think more of the inflation argument, or more of the inflation was driven by the supply as the world came back online again and there was restricted supply. So I don't think the Federal Reserve could have done a lot differently. I think you would have taken some of the inflation out for sure. So for me, it's looking at the macro environment. The macro environment is not easy to trade either. You kind of, being short in this environment in equities, how much further downside? Well, if you go back to every tightening phase from the Federal Reserve, the market tends to sell off about between 15 and 28%. And we've kind of in that zone. So should it go any further? If we're in a full recession, then it's different. But we also have the reaction function from central banks when we get into recession, is they're going to use the balance sheet. Now, we might see direct transfer payments, i.e., tax rebates or whatever version to offset the energy costs and the inflation costs. Well, that's actually a net printing of money. And I think that's a positive for the market that's likely to come. So the macro markets are actually quite difficult to trade right now. The dollar feels like it's going higher, but I think it's not going to be in a straight line. Bond yields, I think, will probably top out somewhere between here and 225 in the 10-year bonds. But we're kind of still a bit in no man's land. We sold off, didn't really stick in terms of yields. It's not an easy place, but I'm trying to sit patiently. I'm long a bit of bonds, long a bit of gold, and long crypto, and long some dollars, and just kind of waiting to see. I don't think it's the time to take aggressive bets yet. 2020 is not a good example because it was a 2-month recession and it was met by the largest stimulus the world has ever seen. So you need to go back and look at 2008 and 2001-2 and look at how long a bear market lasts if there's a recession and how deep it was. In those cases, they're generally 50% downside and they tend to be 18 months long.
Okay, so you say
so we don't know where we really are in this situation. Don't forget the reaction function of central banks has changed now, so they tend to be faster on the trigger. But this one's different because we've got high inflation. So there's a lot of unknowns for all of us in this. We don't know their reaction function well enough yet. That's what recessions lead to. That's not what causes the recession.
okay.
Right? So what happens when growth contracts and the price of collateral falls or leverage contracts, it exposes the weakest hands. So that's why we saw those situations. If we had a full recession now, what would be the thing that blew up? Probably nothing. And the reason being is the central banks don't want the collateral to go bust because leverage is too high. So we saw them already in 2020 buying credit. That was them saying we can't allow that to go bust, even though a healthy cycle is weak borrowers should go bust. But they can't allow it. It's too much leverage. So it's a really different world.
Raoul Pal shares his crypto allocation and an insight into his personal crypto portfolio.
Mine haven't changed at all. I haven't taken a penny out. The riskier end of the curve, I had thematic strategies. So I had DeFi, I had some metaverse, I had some layer 2, some layer 1s, but mainly, it's 80 odd % ETH. The riskier end of the curve got killed. Some of the metaverse stocks did pretty well in a bear market for a period of time. It's like, for me, that's fine. And only so therefore, if I think of the risky side of the market, I took a small amount of risk in that. I then topped up with ETH calls because that was I thought we had a decent probability chance of an upside break at the back end of last year. Didn't happen. So lost the money in the calls.
Expired worthless, yeah.
Expired worthless. Well, haven't expired yet. If ETH gets to about 15,000 by 2 weeks, I'll be in the money. So you know, and that's fine for me. So really, what I've been doing is looking to allocate more over time, slowly, because this is not a market I try and time, because I'm not really interested in that. And you know, I'm not a shorter term guy. So I'm looking where to allocate and how to allocate. I'm still struggling to find a better bet than ETH as a risk-adjusted reward over, give it a 12-month time horizon. Yes, others will do better, but you know, you got the changes to ETH coming. That's all coming by the summer. I think also we're going to get the Bitcoin ETF, the spot one out. From what I'm hearing through back channels, that there's at least 2, maybe 3 that are going to get approved, and that's April. So you know, now that doesn't mean that people rush into that because Bitcoin's going down. So why would they? But at the margin, these are positive news flows.
Though Bitcoin and Ethereum have both had ups and downs short of their all-time highs since then, many experts still expect Bitcoin's price to exceed $100,000 at some point. The volatility highlights a durable truth for Bitcoin. It is still a highly volatile and risky asset. So what should crypto investors do in light of this volatility? Nothing. Given the crypto's history of volatility, this increase doesn't guarantee a long-term reversal. Bitcoin's price is just as likely to fall back down as it is to continue climbing. The future of cryptocurrency is sure to include plenty more volatility, and experts say that's something long-term crypto investors will have to continue dealing with. So, do you agree with Raoul Pal on Bitcoin performance? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.